Today, we're diving into something called Pragmatic Asset Allocation, PAA for short.
Right.
Think of it as like a middle path for investors. You want maybe a bit more than just passive indexing, but you don't have time for, constant trading.
Exactly. It tries to find that balance.
So it sets rules, clear rules to guide your investment mix. And the idea is to, keep costs down, taxes, trading fees, that sort of thing.
Yeah, minimizing drag. And it's a really interesting time to look at PAA, isn't it? Given how confusing the market's been in 2025.
Definitely. Lots of mixed signals, macroeconomic uncertainty. It's been a bit messy.
So our goal here really is to see how this rules-based strategy has actually, held up. Is it working as intended?
And for this deep dive, we're drawing on analysis from Quantpedia. They've been tracking and testing this PAA model.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so let's get into it. The core of PAA, it seems to really center on the yield curve inversion. What exactly is that, and why is it so important here?
Okay, so yield curve inversion. It's when the interest rates, the yields on short-term U.S. Treasury bonds go higher than the yields on long-term ones.
Which is the opposite of normal, right? Usually you get paid more for locking money up longer.
Precisely. So when it flips, when it inverts, it's often seen as a sign that investors are getting nervous about the future, maybe expecting slower growth, maybe even a recession down the line.
Like a warning signal from the bond market?
Kind of, yeah. Potential economic headwinds ahead. That's the theory.
And we've seen that signal flashing, haven't we, for quite a while. The data shows this latest inversion started way back in 2022.
It did. And it lasted, remarkably, a record 25 months.
Wow.
Yeah, it dipped briefly end of 2024, but then popped right back to the same level early this year, 2025.
So that's a really sustained period of, let's say, caution being signaled.
It is. And that prolonged inversion, well, it lines up with what we saw in the U.S. stock market early in 2025. Confidence wasn't exactly high.
No, definitely felt that. Political uncertainty may be playing a role, and stock performance, like the SPY, wasn't great.
Right. So the theory and the reality seem to connect there.
Okay, so the yield curve signals potential trouble. How does the PAA strategy actually use that? Our sources mention two versions, slightly different takes. Let's start with the original PAA model. What did its portfolio look like recently, say, early 2025?
Okay, the original PAA, as of the last quarterly check-in, was quite defensive. It had about 50% in gold.
Half in gold. Wow.
Yeah, significant. Plus a good chunk in cash. The rest was basically in U.S. Treasuries.
So very little in stocks then?
Pretty much none, yeah. And that positioning, interestingly, worked out really well in early 2025.
Because it missed the stock market dip.
Exactly. It avoided that downturn, so it actually turned into profitable performance while broader markets struggled. It shows that safety-first aspect kicking in.
Protecting capital in rough seas. Makes sense. And what's next for this original version? Any changes coming up?
Well, based on the rules, for the upcoming quarter, it's set to dial back the gold and cash a bit.
Oh, interesting. Shifting already.
Seems so. And it's planning to add new positions in emerging markets, using the EEM ETF, and also the broader global market, the MSCI World Index.
So maybe seeing some opportunities outside the U.S., or perhaps the signal is weakening slightly.
Could be a bit of both. The rules dictate the shift.
Okay, now the other version. The PAA with the amended yield curve signal. What's the difference there? How does it read the signal?
The key change is timing. This amended version basically says, okay, the inversion signal is valid, but only for 12 months.
Ah, so it has an expiry date on the warning signal.
Kind of. After 12 months, even if the curve is still inverted, the portfolio adjusts as if the signal isn't active anymore. It doesn't stay defensive indefinitely just because the inversion persists.
Right, less persistent trigger. So how did that translate into its holdings in early 2025? Must have looked different.
Very different. This amended version was mostly in stocks, primarily U.S. tech, using the QQ tracker, and also global equities via the MSCI World Index.
Okay, so much more risk on compared to the original.
Definitely. And as you'd probably guess, given the market turbulence we talked about,
It didn't fare as well.
no, it underperformed the original PAA model in early 2025 because it was holding the assets that went down.
Got it. But the analysis also mentions its decline wasn't quite as bad as, say, the S&P 500, the SPY. Why was that?
Good point. That's likely down to diversification. Even though it's equity heavy, it wasn't just U.S. stocks. It had global exposure, plus, I think, small bits of gold and cash still in there.
Okay, so diversification provided a bit of a cushion, even within an equity-focused stance.
Exactly. Soften the blow compared to a purely U.S. index.
And what's the plan for this amended version going forward? Any shifts there?
Yes. Similar direction to the original, interestingly. It's planning to reduce the U.S. tech allocation, the QQQ, and put more into emerging markets, EEM.
So both versions are kind of moving towards emerging markets now.
Seem to be where the signals are pointing them, yes. Though maybe the allocations differ slightly.
So we've got these two versions reacting quite differently in the short term, 2025 favoring the original's defensiveness, maybe 2024 favored the amended one's equity tilt. What about the long game? How do they stack up over longer periods?
Yeah, that's a crucial point. Looking back further, say up to the end of 2023, the analysis showed basically no significant difference in long-term performance between them.
Really? So over the long haul, these rule tweaks didn't create a huge gap.
Apparently not. They seem to deliver pretty comparable results. The divergence we're seeing now is more about how different rule sets navigate specific short-term market phases. 2024 was good for equities, favoring the amended. Early 2025 good for gold, favoring the original.
Which kind of reinforces the idea that maybe the most important thing isn't the exact tweak, but having a sound, consistent, long-term model in the first place.
I think that's a fair takeaway. It's about the overall framework being robust over time, rather than nailing every short-term wiggle.
And this ties into the broader appeal of these semi-active models like PAA, right? Especially now with people murmuring about, stagflation risks.
Absolutely. That potential mix of rising inflation and slowing growth. It makes strategies that can adapt more appealing. PAA's ability to shift, based on its rules, from riskier assets like stocks towards safe havens, gold, cash, treasuries, when signals flash red. That's a key potential benefit.
That's flexibility.
Yeah, it's flexibility driven by rules, not emotion or frantic trading. The aim is to potentially smooth the ride, reduce those big drawdowns during volatile times compared to a static buy and hold everything portfolio.
Protect capital when things get choppy.
That's the goal.
Okay, so it's about being proactive based on rules, not trying to be a market timer in the crystal ball sense. But are there downsides, any potential pitfalls with this kind of approach?
Well, nothing's perfect, right? The short-term performance differences we just discussed between the two versions, that highlights one aspect.
Yeah.
Depending on the specific rules you choose and the market environment, your PAA variation might lag other strategies, or even the benchmark, for periods. It's not guaranteed to always be defensive at the exact right moment or aggressive at the exact right moment.
So the rules might be simple, but the market interaction isn't always simple.
Exactly. And also its reliance on the yield curve as a primary signal. Well, that signal's predictive power isn't infallible.
It's not a crystal ball either.
No indicator is. Remember that brief dip in recovery of the inversion late last year? While it didn't throw the original model off much this time, it's a reminder that signals can be noisy, or even give false positives or negatives sometimes.
So you're tied to the reliability of your chosen indicator to some extent.
You are. It's a key part of the mechanism.
Okay, so wrapping this up then, when we look at PAA's recent performance in this challenging 2025 market, what's the main takeaway?
I think the key thing is that both PAA versions we looked at are built for the long term. They aim for solid performance relative to a global benchmark like MSCI World over time. These short-term variations we see, like one favoring gold while the other favored stocks earlier, that's kind of expected within a rules-based adaptive strategy.
It's part of the process.
It seems to be, yeah.
And for you, the listener, PAA represents this, pragmatic option, a structured, rules-based way to navigate changing markets, potentially smoother than just holding on passively, maybe less stressful than trying to be a super active trader.
It offers that middle ground. And that leads to maybe a final thought for you to consider. This whole idea of balancing simple rules with dynamic adjustments, how might that apply to your own approach? Not just investing, maybe other areas where you face uncertainty.